Hey guys, it's Josh Brown. Welcome to Big Trends Monthly. I'm here with JC Parets of All Star Charts to break down the monthly closing candlestick charts to reveal the most meaningful market moves around the world. Candlestick charting originated in the 1700s as speculators in the rice markets of feudal Japan saw the advantage of visualizing the four most important prices of each day: opening, closing, high, and low. As each month comes to an end, every investable asset class produces a new candle on its monthly chart. These are the most notable monthly candles and the stories behind them. Let's get into the first chart that you have for us today. What are we looking at here?
Well, I think it's quite obvious that we are getting an expansion in participation, right? So everybody's talking about, okay, NASDAQ new highs, S&P new highs, Dow new highs. We want to ask ourselves, are more stocks participating? In other words, are we getting an expansion in breadth? Are more sectors participating to the upside? Are more countries around the world participating to the upside? Are new countries that were lagging now taking over that leadership role? And the answer across the board is yes, 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 and yes. Focusing here on the United States, since you only let me bring 5 or 6 charts, this is my way of bringing in 6 more. And I just really think it shows the point. I mean, healthcare, communications. I mean, when was the last time you could say materials were making all-time highs?
All right, let me push back and see what your answer to this is. You've got sectors making all-time highs, and without a doubt, that's bullish. And we can debate index membership, which we won't spend time doing here. Suffice to say, these aren't perfect representations of the economy.
In whose opinion?
Well, they're ETF charts. They're good enough. I wanted to say to you, or see what your thoughts were on this idea that within each of these sectors, it's probably only 3 or 4 mega cap stocks that are doing a lot of the work, and the breadth within each sector is not as good as it is, let's say, in technology. What's your opinion of that take?
Your best players are supposed to score most of your points. So the fact that the best players are doing so well is not a bad thing. In fact, right. All of these ETFs and the S&P 500 for that matter is the greatest momentum strategy ever. Why? Because it buys more of the ones doing the best and it buys less and kicks out the ones doing the worst. So right. This is just a normal characteristic of a bull market. Classic.
Okay, so you got staples working out, which people, I guess, used to think were defensive. Now they're related to...
They are. And it's staples making new highs is not bearish. Staples making, go back forever. Staples making new high is just a characteristic of the fact that the stock market is making new high. And staples are stocks.
Right.
Not bearish.
And arguably, there are a lot of growth companies within the staples.
And they're underperforming. Sector. They're making all-time highs and they're underperforming. Which, if staples are outperforming, that's when there's a problem.
Wait.
And that's not happening.
So let's go into your next chart then, because you're looking at consumer staples versus consumer discretionary. So before you even explain what we're looking at here, basically consumer discretionary, people feel that it's somewhat of a proxy for a stronger economy because it's people spending money on things that they don't necessarily need, which I don't really buy that, but fine. And then they say like staples is somewhat defensive because it's people buying basically groceries and Band-Aids.
And beer and cigarettes.
Yeah, right. And of course, it's not quite that black and white. But okay, what are we looking at here?
Well, I think you said it, right? You have your consumer discretionaries, automobiles, home builders, retailers. That's where we spend our discretionary income theoretically, right? Then you got your staples. These are the things that we're going to buy no matter how bad the economy is. No matter what, we're still going to brush our teeth and wash our dishes and smoke cigarettes and drink beer and soda and all that stuff. Staples.
Right. All at once.
So what this chart represents is the long-only mutual fund community. The way these guys get paid is to outperform their benchmark. They can't get short. They can't go to cash, right? In their mandate, they need to be like 95% allocated in large caps or whatever. So the way that they outperform is that they will overweight consumer discretionary if they're positioned for the market to go up so that they can get that outperformance. And if the market's going to go down, they can't short, they can't go to cash, they overweight consumer staples and underweight the discretionaries. And that's how they generate their alpha. But this doesn't happen overnight, Josh. This is like a cruise ship, right? You can see a cruise ship doing a 180 because it's this giant thing that takes forever. This is that.
Right. So it looks like in this chart, there was this huge leg down in discretionary. The staples did very well, and so this is a ratio chart. So it's basically a function of all of a sudden people just said, you know what, I'm going to safety. I want to own supermarket related stocks and drugstore related stocks, and that made sense. And then it seems as though it turned on a dime, even though like you said, it's a cruise ship. It seems like all of a sudden, all the discretionary stuff just started to roar, and that's probably a function of economic stimulus, et cetera. But it's pretty remarkable to me.
Okay, the way I look at it is, who gives a damn what caused it, right? Like, that's not our problem. Our problem is to identify if there's an overwhelming amount of demand for these particular assets or if there's more supply. We can argue back and forth as to why there's more demand, but who cares, right? And another thing that I'd like to point out is that this has been going down for 2 years, which we can argue that this 30-month bear market, because if you look outside of the United States of America, like if you look at Earth, stocks stopped going up in early 2018. So this chart is a function of just risk appetite globally, right? So the fact that we are breaking out, confirming chart number one that had 6 all-time highs, right? It's really just reaffirmation that, yes, in fact, we are in an uptrend. And this answers the question, in my opinion, should we be spending our time looking for stocks to buy, or should we be spending our time looking for stocks to sell? Right?
Okay.
And I think it's the former.
Okay. Speaking of stocks to sell, your next chart, you're showing the 10-year yield, which hopefully we've seen some sort of a bottom here. But then you're showing regional banks versus the S&P as a ratio chart, which is now at an all-time low. This is fascinating that you could have consumer discretionary breaking out, material stocks at all-time highs, and have the 10-year yield, I know it's bounced somewhat, still around 70 basis points. What the hell is going on here?
So this goes back to the chart that we looked at in the pilot episode of this. One day we're going to be signing like the autographs of like that pilot episode, and it's going to be U.S. Treasury bond interest rates hitting all-time lows. So if you recall, 10s and 30s closed at all-time lows last month, right? The lowest since the dinosaurs, right?
Yep.
So now, since this is a candlestick show, look at the outside month that 10s put in. And by the way, I don't have it here, but 30-year yields also put in outside month. So in other words, we got lower lows and then closed at the highs, essentially engulfing the entire previous month, which is a very powerful reversal. What I'd like to also point out is that regional banks closed at new all-time relative lows. So I think that if this is the low in interest rates, we're going to need to see some rotation on a relative basis into regional banks, which we have yet to see. And another thing I'd like to point out is that while technically, yes, all-time monthly closing lows on a relative basis for regionals, it was like by a little bit. Like, it's hanging on by a thread. If there's going to be a reversal, if financials are ever in their lives going to start to outperform, I think this would be a logical place for it to do that. And if they don't, then I don't necessarily know that I buy this reversal in rates. So there's a lot of intermarket stuff going on here, which is fascinated by as yourself.
When you say we're going to need to see the regionals start to outperform and that chart to reverse, just as potentially yield charts are reversing, you have to have the confirmation on the equity side in order for what you see in the debt market being real, or not necessarily?
You know, we're reverse engineering the intermarket relationships here, right? So we need to think about what the environment's going to look like if rates are ripping higher. What does that look like? I don't see regional banks making new relative lows in that environment. I see them outperforming real estate investment trusts, for example, that pay a higher yield, where if rates are going lower and fixed income investors can't get their yield in the bond market, you're going to see that sympathy bid in equities, right? And you're going to see REITs outperforming in that environment. So if we see the opposite and regional banks are outperforming the market and REITs overall, that's consistent with higher rates. We'll look at copper gold ratio. Copper outperforming gold, also consistent with higher rates. So those are the intermarket relationships that we're looking for to, yes, in fact, confirm what the bond market is doing. Yeah.
Yeah. So regional banks, what they really need for earnings growth, and I know you're talking about price action in the stocks.
Thank God.
But what they really need for people to want to buy them again, which they haven't wanted to for a long time, is not just higher rates, but it's a higher spread. Net interest margin that they can actually make money. They need the curve to steepen. So in English, they need to be able to lend long and borrow short. And they are, I think, a really fascinating sector. They haven't had as much consolidation as the mega cap banks have. There are just so many of them in that index, and it's just really fascinating to watch. So if they are bottoming it out, and that coincides with curve steepening and on an absolute level yields going up, that would be a very big reversal that I don't think most market participants are positioned for. And why should they be? It's been a widowmaker trade.
But on the institutional side, right? If they're in a sector and they're overweight the hell out of something like, let's say, tech, and tech puts up a 1% or 2% in a month or a quarter, or God forbid it's down, and something like financials or energy or material, something 7%. Is up double digits, and you're not in that because you're overweight the thing that did nothing, you're in trouble.
Right. If you're being judged on 90-day periods of time, you're in trouble. I want to go to
but that's the way it works. That's the way the real world works, Josh.
Fully agree. I want to go to Dow Industrial Average components. So basically, we have a scenario where Apple did a split, and it's going to go from being a 12% weighting in the index and very important to the Dow's movements each day to being much less important. I think it's going to be the 18th largest component out of 30. And so now the Dow and Apple will not be as highly correlated. But what are you showing us here?
Well, this is the most important stock market index in the world.
Everyone's going to throw tomatoes at the screen now.
What else is new? The more they disagree with me, the more it reiterates how right I am. And I know more about this index than 99.9% of people in the world.
Why is this more important than the S&P? Purely for psychological reasons, because people quote the market in Dow points? Or is there something more to it?
Well, first of all, the S&P and the Dow move tick for tick together. Zoom out. They look identical. So that's one thing. And if you're going to do a sum of the parts analysis, right, you have two options. You could look through all 500 S&P stocks if you'd like. We do, but we do this for a living. Or you could look at 30.
Okay.
It'll take you 20 minutes, right?
Okay.
It's the most important stock market index in the world, hands down, not even close. So with that being said, we had a little shakeup, a very interesting shakeup. The geniuses over at Dow Jones decided now's the perfect time to take energy out and add more tech.
They always sell bottoms and buy tops. That's what they do.
Classic. Yeah. Like you couldn't have done this a few years ago, kick out Exxon before it crashed, you know? So basically what they're doing is they're taking out energy, adding more tech. Perfect timing, right? And then they're switching, they're taking out Raytheon, adding Honeywell, so keeping the industrials, and then they're kicking out Pfizer, adding Amgen.
Isn't the Raytheon thing merger related or not necessarily?
That's above my pay grade.
All right, fair enough. Okay.
Yeah, I mean,
and then they're adding another tech stock. They're adding Salesforce, which I think stepped over Alphabet.
I think Salesforce is now the third largest component in the. So what's interesting is that the new components are now 16%. So there's two charts, right? So there's the first chart that shows the old weighting where Apple was such a monster. So by the way, just so you know, this bubble chart, the further it is to the right is the performance since June the 5th, which was the internal former pivot high. So we anchor to that date very specifically for a reason. We don't anchor to arbitrary beginning of months or beginning of quarters. That's silly. We anchor to where the market suggests there was turning points. So that was June 5th. And then on the y-axis, it's the drawdown from new 52-week highs. So in other words, if it's up to the upper right, it's fantastic. If it's down to the lower left, it's a piece of crap. So that's where you'll find ExxonMobil and Raytheon. And now you're seeing that now with the new weighting, with the Apple split and the new components, the dynamics have changed dramatically. But keep in mind, this is if you're not following the Dow Jones Industrial Average, I don't know what you're thinking. Do not fight Papa Dow. That's the old saying.
So now Amgen, United Health, Home Depot,
Yep.
Microsoft, these stocks move up in importance because of the fact that Apple is moving down in importance. It's not a vacuum. Other stocks have to now step up and become more important to what the Dow does each day.
Yeah. Watch energy start to outperform now.
I was thinking that, but then I was thinking when I started in the business, I think U.S. Steel was in the Dow, and I think there might have been even a coal stock, and I don't think the Dow lost anything by jettisoning those groups. So maybe oil will be more like that. Let's get into this China A shares. So these are blue chips that trade on Chinese exchanges. For the most part, U.S. and European investors cannot really trade them or buy them. And so the thinking goes, if you pull out the fact that some of them are state-run or state-operated enterprises, for the most part, it's a good gauge of sentiment amongst Chinese mainland investors. I know there are connections to Hong Kong, but for the most part, this is Chinese investors expressing bets on their own domestic companies. Do I have that right?
Yeah. You're 100% right. I would kind of dumb it down a little bit and just say very simply, notice that peak in 2018. And remember how I said before, over the last 30 months, the world hasn't gone anywhere?
That's the onset of the trade war, right?
Is it? Okay.
Yeah.
I have no idea what you're talking about, but doesn't matter.
Okay.
In 2018, China peaked. So did the rest of the world. If you want to blame it on something called the trade war, fine. If you want to blame the stars and the moons, that's cool too. All I know is that one of the most important stock markets on planet Earth is now breaking out above those 2018 highs. I don't care what the reason, the Fed, the Trump, the this, that's not my problem. My problem is that we're making new highs. So my problem would be if we're short emerging markets and China stocks, right? And if you recall, going back last month in the pilot episode of the show, we talked about the best performers in July. And if you recall, emerging markets in China were right there at the top.
And Chinese stocks are a bigger part of the emerging market index than ever before. So that's one of the big changes in EM versus even 3 or 5 years ago, is the influence that the Chinese stock market now exerts on that asset class.
And I think this is part of that inflationary commodity sort of, participation that we're now getting, right? Copper making new highs, emerging markets outperforming, China breaking out to new highs. To me, that speaks to higher rates, so that's really what I'm looking for.
Okay, so it's confirming some of the things that you're seeing.
This is like when people tell me, oh, JC, the stock market's a bubble. It's only 5 stocks. It's like, all right, what about China? What about Taiwan? What about the fact that materials are freaking making all-time highs?
Yeah. Oh, those don't matter. Taiwan Semi, which is a $400 billion market cap. I don't know what that is. All right, good call.
Great speakeasies in Taiwan, by the way. Excellent.
Let's get into your final chart, which is an emerging market growth stock. A lot of people look at Latin America and Europe and they're like, there's no tech stocks. This is like, there are several e-commerce and mobile payment publicly traded companies in Latin America. Most of them are based in Brazil or trade on Brazilian markets. Many of them have ADRs, meaning U.S. investors can buy them on the NASDAQ or the NYSE. This is Stone Co. I looked at this thing. I missed it. But this is a company that basically facilitates e-commerce. What are you showing us here?
So we have this thing that it has been internal that we've been building where we call it the 2 to 100 club. We call it the 50 bagger club, where we're looking for stocks graduating from small caps to mid caps that are going to be, 2 billion, that are going to be the next $100 billion companies. It's a very Howard Lindzen sort of list, right? It was actually somewhat his idea.
Yeah, he loves that.
And then it's like discretionary, consumer, DTC, tech, software, companies that can go from 2 to 100. And it doesn't necessarily mean that we're looking for 50 baggers. We're happy to participate along the way, right? We could take chunks along the way. So this is that. A great example. And then notice how we're breaking out to new highs, because part of the filtration process is that it needs to be making all-time highs. It needs to be one of those industry groups. It could be anywhere in the world, to your earlier point. Now we're looking at a $15 billion company breaking out of a multi-year base to new all-time highs. To me, it makes sense. If we're above 45, this is still a long. I think it goes to 63, and then I think it goes to 90. And the $100 roll, right? That's the JV trade. If it's going to 90, it's got a hundo written all over it.
That's my favorite superstition that I know is true. I can't prove it, but I just know it. This reminds me a little bit of IBD and like the Can Slim stocks, but I know you're not incorporating like earnings.
You know what
growth
I don't
and
like
stuff.
about those is that they incorporate fundamentals. That's the problem. If they kicked all that other crap out, they'd have a better list.
So what are you going to call this list? The 2 to 100 billion club? You got to come up with something catchier.
50 bagger. Like, remember how 10 bagger used to be cool? No. 50 bagger.
All right.
That's
I like
cool.
it. All right. So we'll keep an eye on Stone Co. Listen, let us know what your thoughts are and leave us feedback. Make sure you're checking out All Star Charts, which is JC's blog. We're going to have a link below so you know where to click and find more of his insights. And JC's got his own YouTube channel. What's the channel called? Is it All Star Charts on YouTube?
Yeah, real clever. You saw how I did that?
Whatever. We'll link to that too.
And then also, I got one more thing. If anybody wants, go to email candles@allstarcharts.com, password candles, and I'll invite you to our private meeting on Wednesday night, where we go over all the candles from all over the world. So I'll invite you. You could join the rest of our clients and see what's up.
That's killer. Love it. All right. Thanks, JC. We'll be back soon, guys.